Um, and we will get started, and I imagine we'll probably have a few more folks filter in. I know many people who are Zooming are not in a position to turn on video or on the road or whatever, but if you're able to, all the better, just because that makes at least a better experience for me. So this is this month's version of the Wealth Builders Group. We gather every month and talk about different ways that we can think better and act better as it relates to building wealth, because what's it worth us to sell a bunch of real estate, but to not keep any of it, to not grow any of it, and eventually have more options by making good choices as we do. So the conversations vary from month to month. We talk about your goal planning as it relates to building wealth. We talk about real estate investing. We've done some deal analysis a couple months ago. So it's always something different. This month, I'm excited to have a special guest who has a heck of a lot more knowledge than I do on this topic, come and talk about kind of mindset and strategy, and how should we think through ups and downs of the market. As I talk with people, and I love talking about wealth, I love talking about money, a lot of people have this sort of, yeah, but what if? But what if I lose it all? What happens if the market crashes? There's lots of, I would describe it as uninformed paranoia as it relates to savvy and thoughtful wealth building through investing. So I wanted to have Mr. Rick Shostet join us, who is a pro, who is a pro and does this professionally. So Rick, tell us a little bit about you, and then we'll let you dive into the conversation.
All right. My name is Rick, as he mentioned. I've been in the business about 27 years. So I lived through 2001, 2008, and now 2022, when the market took significant turns downward. And when I can say the first time that I dealt with it was 2001 and 2. I'd been in the business about 5 years, and that was the first time I saw extreme volatility. Everything was down at least 50%. Clients were panicking. I was panicking. I'd been there 5 years, didn't know what I was doing, thought I didn't. You always think you know what you're doing until it hits the fan. And that's why you have to be prepared ahead of time mentally to be ready for a downturn. So I learned through there, I'm kind of speaking of myself, what I learned in 2000, 2001 was that people that were aggressive lost a lot of money, and the people that stayed the course made their money back. But I also noticed that my older clients, who tasked me with making sure they were conservative, lost a lot less, made their money back faster, but still underperformed as far as the aggressive people that stayed invested. So what I learned from that whole thing is you have to have a plan and stick with the plan. So that's a good way to start with who I am and how I think.
Cool. Before we kind of go deep into the topic, beyond helping people build wealth through savvy investing, who are you and what are you into?
So I am married to Lori Holden Shostet, who actually works with you. So those of you that know her know that, and you may or may not know that she does quite well and has done well. And so she makes sure that I do well, because I've got to, keep up with her.
And she's savvy with money in her own right.
She is. And frankly, I actually met her when I bought my first rental. That's how I met her.
Oh, cool.
But after we got together, then she decided, hey, I want to do rentals, and she built her own portfolio of rentals. They're almost all hers. There's hers, mine, and ours, most of which are hers, and she's done a great job of course, when when something's worth something and you pay less for it, and what you can make from it. So her plan was to buy real estate at a good price, and then rent it, hold it long term, and then have that help her in the long run. So there's that. And then we both love being outdoors all the time. Every chance we get that we're not working, we're outdoors doing something, whether it be boating or golfing or skiing gardening, you name it, we're outdoors. So I love life. I don't let too many things affect me. I don't have too many bad days. Even when they're bad, I realize it's going to get better.
I love that. And I think when we talk about wealth, I think it's easy to just think X's and O's and charts and graphs and money. And I think my thought behind wealth, and Rick, you guys live this out, is no, like having money gives you options. And what good is a pile of money if you don't live a life that's worth enjoying, or live a life that's in line with your passions and the things that you're living on purpose for. And so the fact that you live that out, it's not just about growing, it's not just about working hard, but it's about enjoying that as well. I think is something that more of us could learn from. So let's dive in. There's scary headlines. We read about, is something going to crash? We read about interest rates. How do you, Rick, coach your clients? If you're sitting down with a new client who you're kind of helping get them in the right mindset to work with you, what does it look like to give them perspective as it relates to investing particularly in the stock market, for the sake of this conversation?
Well, before the volatility comes, you have, as far as I'm concerned, you have to have a plan. And in my business, it's called a financial plan. You can do it any way you want, but if you're working with a financial advisor, he can do a financial plan for you. If you don't have a financial advisor, you can still go online and, Google best financial plans, and you can in fact do it yourself if that's how you're inclined. But if you have a financial plan, once you get into the financial plan, whether you're doing it yourself or you're doing it with a financial advisor, what you're going to find is you've got to figure out in the future how much money you want to have in retirement. And while you may have no idea what that dollar amount is, you can base it on today's dollars. So let's assume that one person might belong to a country club, have 2 brand new cars, have a second house, and have payments on all of them. For that person, they're going to need a lot of money in retirement if they're going to continue to live their life that way. On the other hand, if you're someone that lives a simpler life, and you have a house and it's paid for when you go into retirement, and you don't have a country club and you don't have all the excesses, then you'll need less money. And you can, when you plug that in, all that into your financial plan, you'll know that I have to invest X amount of money for X amount of years with X amount of return. And at the end, I'm going to have the amount of money I need. The question was, how do I walk my clients through a downturn? Well, with a financial plan, you always know that you need to end up with X amount of dollars. And with that, built into the financial plan, there's something called a Monte Carlo expansion. And what that does is it builds in through a 10, 20, 30, 40-year period, actual downturns of 30, 40, 50%. That's built into the plan, and how long it takes to come out of it. And that will tell you ahead of time, I know I'm going to have X amount of dollars, which will pay me enough for me to live on. And so if you have the plan and it's based on statistics, you know for a fact that you're going to make it. So whether your portfolio goes down 10, 20, 30, or 40%, you're still going to be able to make it if in the beginning, when you put the plan together, you said, I want to end up with this amount of money. It doesn't matter, because the Monte Carlo theory tells you that the market will go down. I mean, the markets are volatile. It's going to happen, but they've always, every single time since the beginning, the markets have always come back, whether you invest in the NASDAQ, the S&P 500, or the Dow Jones 500. Not one of them have not come back and exceeded where they were, even when they're down 50 or 60%.
So Rick, can you go deeper without going too deep on this Monte Carlo theory? What were the findings of it, and what should it mean for our money?
All right. So the Monte Carlo theory will take we got to go back to the financial plan. So let's say you've got two different people, one person that lives a simple life and doesn't need to save that much money and needs to end up with X amount at the end to live their life. Number two is that family spends money like crazy. They plan on spending money like crazy their whole life. And those two financial plans come out where this person obviously has to save a lot less than this family. So once you put that in there, you decide, if I need to get to this amount of money and I only have 20 or 30 years to do it, you have to come up with a asset allocation based on history. And asset allocation has to do with how many large, medium, or small sectors you have plus bonds. And that will tell you statistically how aggressive you need to be to make and end up with your goal of the amount of money. Once you go plug that in, let's say one person can be 30% equities and the other one has to be 80% equities. And then of course it's 30, 70, 80, 20. That Monte Carlo theory, when you plug that in, will tell you that over 30 years, let's just pick 30 years as till you're ready for retirement, will tell you the probabilities of what you will have at the end of those 30 years at a 30-70 or an 80-20. And you'll know ahead of time that I am for sure going to make it. And therefore, I don't have to worry whether the market's down 10, 20, 30, 40, 50%, it's still going to work.
And those percentages, just so I understand, are based upon historic data.
That's correct.
In this number of time windows, 95% of these time windows would have yielded X result. So you
exactly correct.
Okay.
Exactly correct. So if you always look, and of course, the shorter the window, the more volatility you're going to see and the less ability you have for a prediction. But if you go out, 10, 20, 30 years, that's when all the volatility is high and low, which happens to be called standard deviation. And that's just the ability that what you go above what the norm is and what you go below what the norm is. That with those numbers, you know that you're still going to make it. And that's how you end up with the feeling that you can do it well.
So how do you interact with the uninformed paranoid person who would say, well, what if I do all of my investing the day before Brexit happened? Or what if I buy everything when I sell everything at the lowest, buy at the highest? How do you coach, or how do you talk about the what if worst case fears?
Well, for me, I have to build a rapport that they trust what I'm telling them is true. And I think that's the same in your business as it is in mine. If someone's trying to buy a house and you're trying to tell them, and they come up with some lame worry about the well or the roof or the whatever it is, as a realtor, you know that is not a problem because, or this is not a problem because, or we can assume this or that. So I have to build the rapport and the trust. And once I get that, you have to let them understand that the numbers are the numbers are the numbers. They will always be the numbers, and you can't deviate from them, because if you do sell at the wrong time, it changes the entire calculation. In other words, you asked, what if they sell at the bottom? I don't know, I have probably 175 clients. This last downturn, I had two people that sold out. One, his wife made him do it. The other one, it was a husband and wife combination. The husband kept his money in and she took her money out, which, as I'm talking to them, even though they managed their money separately, I knew with their financial plan that even if she pulled out, they were still going to be able to make it. So I tried to talk her out of it, which I didn't. But then after she decided to tell her, I said, well, even if you do this, it's not going to hurt you. So you're going to not have as much money, but you still are going to make your goal in the end. So I think that answers it.
Mm-hmm. Mm-hmm. So when you say, part of what you do is build trust, and that's connected to them knowing the numbers for the layman. So let's act like every person here has never heard of the Monte Carlo theory and doesn't, when you say the numbers, doesn't know what that mean? Are you talking about average S&P performance over the last 100 years? Like what are 2 or 3 kind of figures or numbers that are helpful for people here today to understand with regards to being able to kind of bet on the stock market?
Okay, so the average of the averages is I think what you're looking for. So if we take the S&P 500, the Dow Jones Industrial, and the NASDAQ, which is basically all the stocks, and they're broken down into those 3 indexes. And if we do some form of asset allocation or some combination of those, we know that you're going to make somewhere between 7 and 12% over time. And you can look back 75 years and know that every single time on an XY graph, and you just look at the graph, you combine those 3 in any way, shape, manner, or form, the bar always goes up, because obviously the longer you go, it's easier to see it. It takes out the volatility of the down 50, the down 40, the down 30 once you go over a 20 or 30 year period. So when I say the numbers, it's the average of the averages. And if you built that into your plan and you understand that you're going to make it and you don't sell out, then those are the type of numbers that I'm speaking of.
Yeah, it roots you, every financial tool out there, it has the little asterisk that past performance doesn't guarantee future results, basically. And so I say, well, we can't guarantee the future, but here's 100 years worth of data to give us confidence in this sector, for lack of better language. I'd love to hear, Rick, and we're spitballing here, why beyond the numbers, let's get into the fundamentals. Why should someone have faith in at least the United States stock market?
Well, if you look at today versus tomorrow being at 1 day away or 100 years away, when you look at what we are, there's going to be more people tomorrow than there are today. And when those people come of age and they go to buy a house, which you guys are going to sell them, once they buy the house, you all know that when they buy that house, they've got to buy a new washing machine and dryer, carpet, furniture, whatever it might be, curtains, the whole shooting match, furnace, it could be anything. But if you take that in total and you look forward 100 years from now, if there are going to be more people tomorrow than there are today, and they have to buy a house and they have to buy a car and they have to buy clothes and they have to buy food, all those things that they're going to spend their money on is what creates the stock market and the companies that are in it. And when they're buying their whatever it might be, the companies that sell it to them are profitable, sometimes more, sometimes less. But the confidence is, if we're going to be here 50 years from now or 30 years from now, at that time, there will be more people and they are still buying stuff, whatever the stuff is. And that's how the stock market works, just us spending our money. United States is one of the, well, it's the best as far as that goes, because 70% of everything that happens in the stock market is based on consumers, which means just you and I going out and living our lives, buying computers and buying paper and buying clothes and buying houses. And all that combines, and some company has to sell us that stuff. And those are who we're invested in to make the money we're going to make over time.
So basically the thesis is, so long as there's lots of people, and there will always be lots of people, and so long as there is an environment where they are free to buy the stuff that they want or need, then the companies selling those things will have value, and investing in those companies via the stock market is a bet that's always worth making.
You know what I like? I speak and then you're like an AI chat bot and you just retell what I just said in a better way than I just said it.
No, that's my method for making sure that I'm not wrong.
True. Yeah. So no, that's exactly right.
Well, how do you respond? So the other end of the spectrum. So there's the let's say uninformed, paranoid, worst case scenario thinker. on one end of the spectrum. And then on the other end of the spectrum, there's the, ooh, did you hear about this cool stock? Ooh, I could quadruple my money this year based upon this hot tip that I've heard. More of the hyped up, overly optimistic perspective. How do you interact? And this probably isn't your core client base, but how would you respond to someone says, "Oh, Rick, I've got these companies that I'm excited to invest in. Yeah, you can buy index funds over there if you want, but I'm all in on single stocks." How do you think about that?
Well, the interesting part about that is that story I told about the husband and wife, the one that bailed out, the wife was that person. And I tried to talk her out of that. And she still knows better than me. And she continued to buy and sell stocks. I think she watched Kramer, and that's how she got her knowledge, but that's a whole nother story. But
He's our speaker
husband,
next month.
go ahead.
He's our speaker next month.
I gotcha. So what the interesting part is, I keep comparing her to her husband over the last, well, I probably been working with him about 12 years, and her volatility is much higher, and she has to spend time doing and worrying. And I never talked her out of it. And the other husband is totally bought in, and he just relaxes, doesn't even hardly look at his statements because he's got a plan. He has that asset allocation, he knows it's all going to work. All he has to do is listen to his wife in his ear, tell her how great she is, listening to Kramer and buy her stuff. Now, that's an actual situation, but the reality of it is, when I talk to those people, I say, look, as long as we can fit, if you want to buy, and make it simple, Apple. Everybody loves Apple. I've probably got that in a lot of my portfolios. I don't have it singularly in my own portfolios that I build for people. But when I talk to those people, I say, look, if you've got a plan, and the plan is, if we've got this many stocks, this many bonds, if you want to take 2%, for instance, or 1% of your own money and buy Apple and buy Amazon and buy Netflix, for instance, those are three hot ones. Go ahead and buy 3 to 6% of them. It's not going to hurt our financial plan. It's not going to hurt our asset allocation. If that makes you feel good, it's your money. I'll go ahead and do it. But so there's the extreme of the one woman I told you, and then there's the other people that if you want to be interested and you don't want to just look at your fund because the fund doesn't really tell you what it's doing, and you want to have some of those, as long as you don't overinvest in any one company or one sector, then you're going to be okay with your financial plan. Again, we got to go back to the beginning. You have to have a financial plan, whether you do it or a financial advisor does it. So you've got a reason to do what you're doing and understand why you're buying or why you're selling at any given time.
Yeah, I think, and that's true for almost any major undertaking, is if it's just me and my research making decisions here and there, that's one thing. But if it's not ruddered to some sort of framework, then it's just, it's based upon what I had for dinner last night or the latest article that I read. And I think I know too many people that they approach their money that way. Yeah. Did you hear, either positively or negatively, but it's not ruddered to any sort of cohesive plan.
That's, like I said, even if you don't have a financial advisor, you can go online and get your own financial plan by Googling best plans and just do it. But I think if you're doing well enough in the business to be in this group that is listening to me, then you should know that financial plan, if you didn't know it before, you should know now that a financial plan is available to you. You can plug it in, just like you work hard to sell your buy and sell your homes. You've got to have a plan to do this, and that backfills everything, especially your emotions. When things get crazy, understand that it's built into the plan to lose, anywhere between 10 and 50% anyway, and you're still going to make it at the end of your time frame.
So give us, we don't need to pull it up on Google, and you don't need to pull out your standard one here, but give us the components of a plan. You mentioned earlier reverse engineering your retirement goal,
right?
what is it? Is it an anticipated desired monthly outcome at some future date minus time? Give us the kind of the building blocks of a good
Yeah,
financial.
well, you have to imagine your retirement, and that goes back to the wealthy person, wealthy family versus the one that could care less. I have teachers now that make more in retirement than they did while they were working, because they lived in your standard, 3-bedroom home that isn't. You can have a 3-bedroom home for 500,000. You can have a 3-bedroom home for 175,000. And they lived in the 175,000 one, not that. Save their money the whole time. And how you build that plan then is, does that person want to end up in that $500,000 home with another $500,000 home in Florida, or are they going to sell that home and only end up with one? But you have to start somewhere. So today, no matter how old you are, you're worth so much. You either have an IRA or a 401k, and you have a house, or you don't have a house, you have multiple houses, and you have to start with today. What is my net worth? How much money do I have? And then whether you're single or with someone, then how much money do I or we make? Well, of that money of that I or we make, how much of it do I spend every single month and every single year? And how much of it is left to invest into something, whether it be rental properties, whether it be the stock market, whatever it might be? That's when you build those numbers and you look forward. When I'm older, I still, the one couple, I'm still going to be living that $175,000 house. And I might want to go to Florida for a month out of the year, and it's going to cost me, in today's dollars, $4,000 a month to stay there. Well, what the financial plan does is factors in, or the other person that has two homes, what the financial plan will always factor in is $175,000 house now will be worth X amount later. It'll cost X amount to in today's dollars tomorrow. So it uses inflation and says, if I want to live on 60,000, if I can live on $60,000 a year now, but I'm making 120, and that's how I want to live later, we can figure out that $60,000 later is maybe going to be 150,000. And how do we get to that $150,000 number in tomorrow's dollars with today's dollars working forward? Mm-hmm. I think that answered your question.
Yes, it does. And it's simple and nuanced at the same time. It's where am I now? Where do I want to be? And what's the difference between those things? How can I get my money working? But I think the nuance, the particularly nuanced part is is time value of money changes over time. And $60,000 20 years ago was, hey, you got a really good situation. $60,000 today, you're doing just fine, but it's not the same as what it used to be. And the same is likely to be true. Caitlin has asked us a question here. How much money does the average person need to get started in investing and get started on their financial plan?
Well, there's two answers to that. One, a lot of financial guys in my position won't even take anyone that doesn't already have $250,000 or $500,000. So if you're established, what you'll find is most financial guys will not work with you. So let's start with that. Back into, if you can find somebody that will take you, which we happen to do that with a lot of young people, even though we'll probably never make a lot of money off them because it takes 10, 20 years down the road. Then if you can find someone, then that's it. If you can't find anyone, you can still go online and you can start with $1,000. I mean, it doesn't matter. If you start with $1,000 and then you add to it every month, we go back to, I think I used if you're making 120, living on 60, that leaves 60, and you can save $1,000 or $2,000 or $3,000 or $4,000 or $5,000 a month. You just continually add in to that 1,000 or 5,000 or 10,000 that you started with, and then every month you start putting that money in there. And based on the fact that it sounds like she was just getting started, you want to go and get that plan put together so that while you're starting with that money, You can start online with any amount you want and buy an index fund or buy a mutual fund, and you can do your own legwork on that.
So yeah, let's camp on that for a minute. I was hoping you'd go there. A lot of people say, where do I start? And if I have $1 million in investable assets, I'm assuming your approach would be a little bit different than giving your advice to someone who's getting started that has $10,000 and is just trying to get that ball rolling.
Right.
Can you talk with us about what an index fund is briefly, and why that's a good bet for someone getting started, like you were just saying?
Okay. So an index fund, well, an index, there's more than this, but basically what you'll see every day is an index, the NASDAQ, the S&P 500, and the Dow Jones Industrials. And what those are is some group of people pick and allow, let's say the NASDAQ. The NASDAQ has almost all technology involved in it for the most part. You've got Netflix, you've got Amazon, you've got Uber, all these companies that are represented, and they pile them all into one unit, and they keep track of them every day, every week, every month, every year. And that is the NASDAQ, for instance. And that is the index that has performed the best over the last 50, 75 years. It has the most volatility because of the names that I mentioned. Because if you look at the S&P 500, it has all the boring stuff in our economy, like Johnson & Johnson, Procter & Gamble, IBM, Texas Instruments, those companies. And again, those are all then lumped into an index, and those have a less return over time and less volume. And then the Dow Jones Industrials are the larger companies that are mostly manufacturing based. And the reason the indexes initially started before investing, because you used to not really buy an index fund. They didn't exist. There were financial groups that had mutual funds, and that was it. But as time went on, the people that created the indexes, and all the indexes are there is for the average person to see is the stock market averages kind of going up or kind of going down right now. And that's what an index shows you. And once you buy those indexes, you can look back historically and say, well, this one's made the most. And if I buy this much of this one, this much of this one, we can go forward. I think I answered the question. Is that right?
Yeah, that's good. It's a broad-based approach where you don't have to know too much. You just know that you're basically betting on your comment earlier. Like if you're betting on people in our country buying stuff, or in our world buying stuff, then buying an index fund is a great way to get started. That's where I spend most of my time.
And that's exactly right. Now, I'm going to deviate for one small point. If you buy a lot of one stock, and I have several clients that own just a ton of Apple. It's anywhere from 10 to, well, I think I have one that she was 75% of her net worth is in Apple.
Wow.
The problem with but she took her IRA probably 25 years ago at $40,000 and bought Apple with the whole thing. Now her husband had other money, but she bought Apple. That's all she owns. And it was worth almost $1 million.
Wow. So it wasn't as though she went, I mean, she did bet the farm on it years ago, but today it's worth 75% of her portfolio because of what Apple went and did.
Absolutely.
Now.
Absolutely. So the reason I mentioned that is you can win big or you can lose big. And I have a book out in my lobby that shows all the companies that have gone bankrupt that were top of the line companies and no longer exist. And even younger people would recognize some of the names. But the point is, who's to say that Uber will be here in 10 years? It may or may not exist. Who's to say that Netflix will be here in 10 years because technology changes and you no longer need Netflix for whatever reason? So if you invest too much money in one company, then you're taking an incredible amount of risk at losing a significant part of your value, which is why that whole diversification thing, going back to the indexes, if you buy an index or a mutual fund, then you can do what you want to do. But the cool thing now is, let's say what I am investing in now is, so if I take 2 to 5% of your portfolio, I will bet on a sector. So let's say the sector is cloud investing. So there are companies out there that are helping companies move their stuff from their own servers up to the cloud. And that's relatively new and has years and years to go. You can actually buy a sector ETF based on cloud. So you're not buying one company. You're not buying, for instance, Microsoft is one of the top ones. There's several others. But instead of just buying Microsoft, you can buy the whole sector in an ETF. If you understand that the cloud is going to be great, then you can put 2 to 5% of your portfolio, not just in the index fund, but over here in the cloud sector. I also use biotech as another one. Biotech is just nothing more than computer information going in and some type of new medication coming out because of the information we have, and computers are getting faster and faster, and we still have about 700 things that need to be cured. And so I put a percentage in there.
But you're making your bet based upon an idea or a trend more than one particular company.
Exactly correct. Because then if you're not betting on one company's new president coming in and screwing the whole thing up. You're betting, just understanding that those things are going to continue to move, and that's why I and you could do the same thing.
Well, and let's jump back to Caitlin's comment. So Caitlin, when you're getting started, or hey, I've got some money, but I don't have $250,000 to work with at this point. Talk about the value, Rick, of dollar cost averaging, and how when you've got time on your side, what is dollar cost averaging, and why should someone that's getting started value it?
Okay. Well, the first thing that we're going to start with time. Time is your friend, because if you look at any, no matter what index you look at, back to the XY axis, you look over 75 years, it goes straight up like this. Now, we crammed that into the last 2 years, and it went down like this, and it still hasn't made its way up. So that's where the emotional part comes in, where do I sell here? And you just can't. You have to stay the long haul. So if you bought, let's say Caitlin started today and she bought $1,000 worth of the S&P 500. And let's say that day was a year ago or a year and a half ago, doesn't matter. So, but we took the $1,000, but that $1,000, if it goes down 20%, she now only has $800. And of course, if you're just starting, you're thinking, I invested 1,000, I lost 200, I'm down 20%, I've only got 800. What am I going to do? Well, if you're buying that, and let's say that occurred over a 12-month period, and let's say you're adding $100 a month to that. So every time you're buying that fund, you started buying it at that when it was worth $1,000 per share. Let's just make it, she bought one share, we'll keep it simple. Then the next share she buys at 950. And the next share she buys at 900. And the next year she buys at 875, and every month she's buying as the market's going down. You just keep buying more. But what's actually happening is you're buying that share that we randomly picked $1,000 per share. You now bought it at all these different amounts, all the way down to 800. And at the bottom one, your last year you bought it at 800. So if you average all those together, now let's just say you've now paid $900 for the average of all the things you paid for, and the market starts to come back up as you're buying. Now you're starting to buy, coming back up every month. Let's just say it's the exact same dollars, and you end up back here 2 years later, and now you bought it at 1,000. Well, during those 2 years, you bought every share that you bought every month below 1,000, going down and coming up. So all of a sudden you've invested that money, but you've actually made, let's just say you've made 20%, because when you bought this one at 800, it went up 20. Even though you were down 20 here, you just made up 20. Then you made 15, then you made 13, and you add all those up. And when you do that cumulatively over 10, 20, 30 years, the dollar cost averaging basically is buying at all those different times. And when you leverage that forward, that's how you get your average return and your money doubles. Basically, if you can average 7% a year, your money doubles about every 10 years. And that's the kind of average of the averages that I use by doing that, where dollar cost averaging actually helps that, because you're buying at the bottom and helping that 7% return.
Caitlin, you turned your video on for a second. Did you want to interact with that? No pressure.
No, it's all good. I was just listening.
Great.
Put me on the spot, so I was ready.
I appreciate it. Rick, one of the misnomers out there is, well, I don't want to quote lose it all. So when you invest in a single stock, you know, an Enron happens, for example, there is an outside risk that you could lose it all on that stock in the event that that company goes out of business.
Right.
Can you tell us, outside of that example, why losing it all isn't a thing when you're investing in the stock market?
The only way you can lose all your money in the stock market is if our thought before was there's going to be more of us tomorrow than there are today. And something so catastrophic would have to happen, like a nuclear war or an asteroid. And at that point, money's not going to matter anyway.
Right.
So there's virtually 0% chance of all companies going out of business. So let's say you buy an index fund, and it doesn't matter if you buy NASDAQ, S&P, or the Dow. And by the way, to Caitlin's question, if you start with 1,000, you can still buy 3 different indexes with that 1,000 to start off with 1,000 and buy 333 of each, just so you know, and start with the diversification. But we go back to the indexes. So the indexes, in other words, the S&P 500 actually has 500 companies in it. The only way you're going to lose all your money is if all those companies go out of business. And if all those companies go out of business, and that would include, you know, anything from whatever it might be, Texas Instruments, all the way over to Procter & Gamble, all the way over to whatever, Xerox, you can't imagine a world existing without those companies. And if those companies don't exist, we aren't going to exist, and it doesn't really matter.
Well, and to add to that, correct me if I'm wrong here, Rick, but I've heard that that indexes are, quote, self-cleansing. So say company number 485 starts failing and drops out of the S&P 500, another company is going to be coming in. And if you're investing in an index fund, you're going to get that new company, not the failing company.
Exactly correct. And even though, let's say Enron, and I don't remember if Enron was in the S&P, it was probably, well, it could have been, or the NASDAQ, but it doesn't really matter, because Enron was one of the exceptions to the rule, where it went out of business so quickly that almost no one would have been able to sell it. It happened so quickly. But let's say you've got 500 companies and one of them goes out of business, you're only losing 1/500th of your portfolio, and the other 499 are still there, so it doesn't really matter. That's why diversification is so important, even though I talked about the one lady that has $1 million in Apple, but that was based on, 25 years ago, but she also has more millions and other things. And even if Apple were to go out of business today, it would be problematic, but she still would make it. So I think that does that.
That's helpful. For the person that's sitting on the sidelines, saying, I just prefer the stability of being able to see my money in my savings account each month. I'll leave that for people that have stronger guts than I do to invest in the stock market or real estate or whatever. Can you talk about why they're actually taking a greater risk than someone who's investing in the market?
Yes. So if you were to take a financial plan, and again, you can do without a financial advisor, you can do your own. And if you plugged in how much money, let's say you even have 150,000, 250,000, 350,000 in your savings account. Of course, you're not making, but you're virtually making no money on it because the banks are not going to pay anything. But if you plug that money in over time, I mean, inflation, we used to factor in at 2.5%, which I'm not sure when and if it'll ever get back to 2 or 2.5%, but it won't be in
not in the near future.
Yeah, it's not in the next 5 or 10 years, at least 5 years anyway. But the point is, so your cash is sitting there, but it's not making any money. So let's say you've got $100,000 in your account today, and we fast forward 5 years. Well, just trying to get through your day, your week, and your month, you used to live on, if you're living on $5,000 a month now, you're going to need $6,000 or $7,000 a month then, and that money, that 100,000 hasn't made a dime. So you're actually losing money by not investing it, because inflation is eating away at it, because that 100,000 5 years from now is not worth anywhere near what it was 5 years ago. So the only way for most of us, almost all of us, to get to have enough money at retirement is you have to leverage it forward some way, somehow, to make your money make money. And whether that's with real estate or whether it's with the stock market, and that's pretty much what we have to choose from. I can't think of what else there might be, but if you don't do one of those two things, unless you just have oodles and boodles of money, you'll never have enough money to retire, because you're not leveraging your money forward.
By letting it sit, you're actually moving backwards.
That's correct, because of inflation.
Yeah, I think last year was 9%.
Yes.
Which is, just part of the mess that we're in economically right now.
Right.
It will, Lord willing, slowly creep back to what we're used to, but it's been wild for the last couple of years for sure.
Yeah, well, and one thing we haven't talked about are bonds, by the way. And I think you just kind of rung a bell in my head. Bonds, for those that don't know what a bond is, if a company or our country needs money to run, so our country, if United States wants to borrow money to build this or give it to Ukraine or whatever it might be, they have to borrow the money from us, and that's called a United States Treasury. And the United States Treasury is the #1 safest investment in the world, because the United States will pay you your money back, and at the very least, you can buy United States Treasury, and right now those are running at 5%. A year ago they were at 3, and basically, yeah, let's just use 3 and 5. So that's one way to invest without, even if you have cash. The best thing you can do is go buy, and you're totally freaked about everything, go buy a United States Treasury, and you can get 5% for 1 month, 6 months, 2 years, 3 years, and that will at least get you the 5% that you need to start leveraging your money forward. So we'll just speak to that person that's totally freaked and doesn't know what to do with their cash. You can go buy United States Treasuries. You can open up an account online with Schwab or anyone, or you can get a financial advisor and do the same. And that's one thing you can do with your money. Now, the other thing you can do is buy corporate bonds. And let's just say Uber is trying to expand, and they need money to expand. And the name of the company doesn't really matter. I just picked that because we all know who Uber is. They will actually pay you higher than the 5% that the government will pay you, but then you're taking on the risk of Uber going out of business. But you can still get 6, 7, 8% from buying an Uber bond, which doesn't have nearly the same problems that you have with the stock market. But you can still make money, and maybe you buy some corporate bonds, and you buy some treasury bonds. Now, if you know, I'm actually saying buy the bonds, not buy a bond fund. The bond funds are not guaranteeing you anything. As a matter of fact, the aggregate bond fund, which is the index for bonds, last year was down 17%, which is the worst thing we've seen in 50 years. You're not guaranteed to get your money back. You're gonna have to wait to reinvest that to get it back. If you buy individual bonds, you're guaranteed to know that you're going to get your money back. And in this day and age, when you can get 5% from a treasury, that's probably the biggest portion of what I would do with your conservative money, is buying individual treasuries, because you're guaranteed to get your money back.
Yeah, no, that's a point. I'm glad you added to the conversation. Who has questions? I've peppered Rick with plenty. None of these were planned, by the way. I'm just lobbing them up for you, and you're crushing it. Who else has thoughts or questions for Rick?
Everybody loves to ask
How
questions.
does a Roth IRA compare to the S&P 500?
So a Roth IRA is a holder, basically a box, and it's a box that you put investments in. Inside that box of the Roth IRA, you can put anything you want in there. You can put the S&P 500 in there. You can put the NASDAQ in there. You can put Netflix in there. You can put Uber in there. So the Roth itself, which is, you put money in there, and when you pull it out later when you retire, has no taxes involved to it. So what you're kind of asked a question that is a little bit dicey, in that the Roth itself can have anything you want. You could put all and only the S&P 500 in there, and it will match the S&P 500 the rest of your life. You can put that in a Roth. You can put it in outside of Roth in your own investment. You can put it in a normal 401k. So
Roth IRA isn't a index fund itself. It's just where you can put things so it's tax free.
correct. That's exactly correct.
Okay.
Yep.
Perfect.
Yep. And it's the same with a regular IRA. And I think I'll add this, since you kind of brought up the Roth. Also, you guys are independent contractors, so you don't have a 401k. You can invest in an IRA or Roth IRA, but maybe you have a significant other that has a 401k. Make sure that significant other is investing in that 401k, especially if the company matches what you put in there. So let's say the company matches up to 4%. If you put, and let's just say it's $100 a month. If you put $100 in, they're going to match it up to 4%. So you're going to get a 4% return immediately when they match you to 4%. But if you really want to look at it, it's 100% return on that 4%. But that gets confusing. Just know that you're getting automatic, for sure, 4% return if they're matching, and make sure your significant other is using that 401k and at least putting in the amount that they have for the matching portion.
One brief comment to add with the Roth IRA, Brendan, is a lot of this stuff depends on your age and your earnings at different ages as to whether a traditional IRA or a Roth IRA may make more sense. But typically, the younger you are, the better off you are to invest in a Roth IRA, simply because when you're old and gray, most of the money in that account will have come from the growth of that account, as opposed to the amount of money that you put into that account. And the growth is tax-free in a Roth scenario. So you'd save, in some cases, hundreds of thousands of dollars by going that route. But talk with a professional who will be able to inform you more. Scott Young, Rick, has asked us about your perspective on e-currencies, cryptocurrencies, Bitcoin, etc.
Well, Warren Buffett thinks it's a joke, that you should never put a dime in it. And there's plenty of other people that think opposite. Cryptocurrency is something that's so, even though it's been around for a while now, is so new that the judges, the perspective of people that are smarter than me are between don't buy a nickel of it and put all your money into it. So somewhere in the middle is where that lands. So if you want to buy some, I would say go ahead and buy some. But you really don't want to, back to my diversification thing, you don't want to buy all Uber, you don't want to buy all Apple, you don't want to buy all cryptocurrency. But as a part of your portfolio, as long as you don't put too much of it in there, I think it's a great idea. Now, if you were to look forward, and let's just say cryptocurrency explodes and makes a ton of money, we go back to the lady that invested $40,000 and now has $1 million worth of Apple. Then you can look back at and say, Rick didn't know his butt from a hole in the ground when he told me not to buy that. I should have bought all that. With that thought process, you have to be able to know that if cryptocurrency, like many other companies and sectors have, and the buggy whip, if you invested in the buggy whip years ago, you'd think that they had the best buggy whip in the world, but all buggy whips are gone now. So you lost all your money. So as long as you do anything in moderation, whether it be crypto, whether it be Apple, whether it be a sector, then there's nothing wrong with that.
Mhm. I've heard it said, if you've got your pet idea, whether it's a stock or whether it's crypto or whatever, you just something that's more speculative, just be prepared to lose it. Like if you're saying, if I were to lose it all,
Yeah.
and would it ruin me or would I be bummed but okay, then you're all right.
And and whatever that investment is a 1 to 10%. I don't like, I try not to let any of my clients have more than 10%. The problem is the lady that had the Apple is just, you can't do it. And especially if it's a taxable account, then you got to pay capital gains on it.
Ooh.
So there are the exceptions to the rule. Unfortunately, the government makes us play a mind game and a money game with a lot of those situations. So I do have people that have, hundreds of thousands of dollars of, if not more, of one stock because of capital gains. So, if you've made $500,000 on one stock and you sell it, you've got to pay so much in capital gains that it makes you not want to sell it. And then you're taking on risk you don't like, but the government's kind of forced you into it.
Time for one, maybe two more questions. Anyone else? Lori, you've been quiet. You wanna hit him with something?
Probably, but it probably has nothing to do with this conversation.
So I wanna start sooner than later because I'm young and I figure I can hold it for as long as possible. Are you your financial advisor is what I'm getting from this, right?
Yes. Yeah.
I'm looking for one. Would there be any chance I can get your contact info?
I'd be glad to share. I can share it with you,
Absolutely.
Brendan.
Yeah.
Okay, perfect. Yeah, if you don't mind texting that to me, that would be great.
Glad to.
All right, thank you.
Awesome. Well, Rick's in addition to being a financial whiz and a great skier and all of that, his most recent claim to fame is having gotten me to admit that I cried in front of a group of people. He asked a tongue-in-cheek question, and I'm like, "Oh yes, I did cry," and he's like, "Oh, I was just joking." So, Rick, I appreciate both your expertise and your good-naturedness, and I appreciate you sharing both of those things with us today. This will be recorded. I'll share it with you all if you want to rewatch it, because we got into some weeds on things, which I clearly love. But if it got dense, Rick, I'd be glad to share his contact information. I'm glad to have a conversation if folks are curious to dig deeper. Thanks all. Enjoy the rest of your Thursday. Any parting thoughts from you, Rick?
No, thanks for inviting me. But if there's anything I can say, start sooner rather than later, and start by trying to understand as much as you can. Obviously, I think a financial advisor is worth the money, just like you guys know that a realtor is worth their money. But even if you don't use a financial advisor, don't let that keep you from doing it. Make sure you at least go online, figure out how to get started, and try and figure out every day, learn something more than you learned the day before. And even if you start blindly with $1,000 and you buy $333 of the 3 index funds, that's a start, and just keep learning from there. And from there, you'll do well.
Awesome. Great parting word. Everyone enjoy the rest of your Thursday and see y'all soon.
All right. Thank you.
Thanks, Rick.